We begin week 3 weekend update video. This is Professor Hassey, again speaking live and in color from a beautiful Claremont, California, this weekend of November 11th, 12th, and 13th. Today, we're concluding our week number 3 capital fundraising discussions of talking about stocks and calculating stock values using models, constant growth, dividend growth model, all giving us the background of a risk analysis as we complete that case number 1 this week due Sunday. If you need any extensions on that, please let me know. Otherwise, I will accept or expect all the work to be posted by midnight this Sunday, November 13th. That'll lead us into our next major block of our class over the next few weeks, capital budgeting, where now that we know where capital comes from, stocks, bonds, we now know the financial situation, the risk situation, the financial situation of our company. Now we can begin to invest in assets and make that provide those returns to our investors in our financial capital structure. So we're going to be studying this over the next couple of weeks, and you'll be having a next case number 2 posted on Monday, November 14th, and you will have 2 weeks to do that case. 2 weeks. So that will be posted this Monday, but you have 2 weeks. So no, don't anybody panic. That'll be a spreadsheet work, and we'll talk about that in our video on Monday. But now let's just take a quick look of where we are here in week number 3. Okay, you should have 1 grade posted to your grade center as of this weekend at the end of week number 3, and that is the discussion post, our very first week, where I ask you to select a company, and I ask you to just tell us a little bit about yourself. If you've done that, you'll see a grade. If you have not done that, let's get at it. Secondly, we'll have our 2nd grade posted early next week as you complete the APA format paper this week due on Sunday. Then we begin to get into case number 2, which you'll have 2 weeks to do. All these cases are 20% of the grade. All leading up to our course assessment case paper, which combines basically all 3 cases into 1 case, which is worth a little bit more, 25%. And we'll talk about that in the coming weeks. So again, as you can see, no midterm, no final examinations. Everything is case study and case work in this class. So just making sure everybody is aware of that. And at the end of this week, you will have a quarter of your grade determined with case number 1, 25% of your course grade will be determined. So I hope all of you had time or points of meeting with me in your student sessions. That's also worth a grade. So if you have not, you'll see no grade there, and that's a shame. You didn't get a chance to see me. All right, let's take a look at our case number 1 one more time. Okay, remember, as you're finishing up your casework this week, you're doing 2 areas of study. One is a calculation of return or risk. That's part 1, where I ask you to find the credit rating of the company, the beta value, which many of you have already done, your capital asset pricing model, or the required rate of return on equity investment. That's the capital asset pricing model, risk-free rate plus market premium times the beta of the company equals the required return on equity investment, or basically called the cost of equity. Then, using that information, you look up your company that you have chosen as far as their capital structure. What percent of debt and equity is the current financial statement say this company? Remember, the current financial statement is balance sheet, assets equals debt plus equity. That debt and equity should total 100%. Once you have those percentages, then you can determine the weighted average cost of capital for this business. In a hypothetical sense, you already have the cost of equity. Now you determine the cost of debt. The cost of debt is the interest rate on the debt, which I give you as 8% to use, and the corporate tax rate to use is 25%. So now you can determine the cost of debt by taking the interest rate on the debt and then multiplying that times 1 minus the tax rate. Though with these two hypothetical costs, cost of debt and cost of equity from the capital asset pricing model, you weight those by the debt capital percentages or the capital structure percentages of debt and equity, and you can determine a preliminary weighted average cost of capital for your company. I want to see those calculations. Then once those calculations are over, now we do a risk assessment of the company, organizational risk, environmental risk. What risk outside of the business does this company have? Quantitative versus qualitative risk. And write a few pages on how you interpret the risk in the market, the risk this company has, and your perspective on it. That's the paper. And the paper is to be a minimum of 5 pages, a maximum of 10 pages in an APA format. Here's that APA format sample that I gave you, which basically gives you the format of what I'm looking for as a typical MBA research paper. Your title page, don't forget Professor Hassey's name, I'm a stickler for that. The date of your report, an abstract where you explained the conclusion and what you're trying to do in this paper, and then the analysis, the risk analysis, risk evaluation of the calculations that you're doing. Now, some of you have asked me, Mr. Hassey, do I include these calculations in the paper? Well, you can, but also you can put in an exhibit in a spreadsheet, and you can post 2 files. One will be your paper. The second will be your spreadsheet showing all the calculations on the spreadsheet, and call that, let's say, exhibit 1, and then you refer to that exhibit in your paper, showing me the details of that analysis. However you want to do it, as long as I can see the calculations and the numbers. Once you're done with that and you explain all those various areas, then you have to put in and just determine the risk perspective, the organizational, the market risk, and set it up like that, all leading to your conclusions and your references of where you got your data for this work. You do not have to use a reference your textbook. You can put everything else where you found your information. Please note it in the references just like this. And that's your paper, a clean, concise report on your interpretation of the company that you selected as a risk analysis for the present day. As part of your study of stocks and bonds and the analysis of the last couple of weeks, chapters 4, 5, 6, 7, here's a spreadsheet that has all the tabs for the chapters. This is updated and included in week number 3 lecture notes, where we talk about the constant growth model of determining the intrinsic value of a stock, knowing their dividend, knowing their growth rate and their expected rate of return. We can determine the required cost of equity, the capital asset pricing model. Here's a sample of it here, which you'll be using in your in your paper, case number 1, and also a determination of corporate value, taking the free cash flow generated off the company and dividing it by the cost of capital. All these tabs indicate the key material of the first 3 weeks of our class. Chapter 4, time value of money. Chapter 5, bond valuation. Chapter 6, risk and return, which we started our class off with. There's that capital asset pricing model again, and determination of weighted average cost of capital. And then chapter 7, stocks, determining the growth value. All these 4 areas are determining the risk and the capital fundraising of a company in the corporate world, where they get the capital, how they measure that capital in relationship to the risk of the company and the risk of the company in the market. And that's what we're all doing these first 3 weeks of our class. Here's a video kind of summarizing this. Let's take a look at it.
In this video, we're going to talk about dividend discount model and how it could be used to value a firm and find a firm's share price. So when we think about a dividend discount model, it's a good idea to kind of think conceptually that we've got a firm, and what we can do is view this firm as a stream of dividend payments into the future for into infinity. We'll just say it's in perpetuity. We're just thinking forever. This firm is just going to spit out dividends. Let's say it's $10, $10 each year. It's just going to have $10, or maybe this number is growing. Maybe it's $10 and then $12 and then 14. Whatever the case, we're somehow valuing this stream of dividends going forward and saying, okay, how can we discount those dividends and just basically value the firm based on these dividends that we're expecting to occur. So we've got one way that's the most popular way of valuing the firm with a dividend discount model. It's called the Gordon Growth Model. So this Gordon Growth Model, it's actually a very simple equation. We're just going to have the P, the firm's share price, that's going to be equal to the dividends in the next period, dividend per share on an annual basis in the next period, and then that's going to be divided by the cost of equity after subtracting the growth rate that we're expecting for the dividends. And so let me just talk about these in a little bit more detail. So we've got P, that's the share price, right? So ultimately, that's what we're trying to solve for and say, okay, well, how much is this firm worth on a per share basis? And then when we've got the D1, we're looking at the dividends per share next year. And then the G is just that growth rate. Do we think that these dividends, are they going to grow at a rate of 3%, 5%, 4%? What do we expect to happen as those dividends go off into the future? What do we think is going to happen? How are they going to grow? And then, of course, we've got our cost of equity that we can solve for. Actually, if it's not given in your problem, you can just go ahead and solve for that using the capital asset pricing model. So let's go ahead and let's work through an example here. Let's see if I have enough space to do it here so you can still see our equation. So let's say that you have a firm and you're trying to come up with a valuation, and in this example firm, you've got dividends per share of next year. So next year, dividends per share, let's say that they're $2 a share. So I'll just change it. $2 a share you expect to be dividends for next year. Not this year, next year. Okay, so now we've got that. We say, okay, well, what's the cost of equity? The cost of, put that there. So the cost of equity, let's assume that that's 12%. And then what do we have for the growth rate? Well, now we've got to make an assumption here, right? So let's just assume that the growth rate of these dividends in perpetuity is going to be 3%. Now the rest is pretty simple because we just use our equation and we plug in these numbers that we're given here. So we can go ahead and calculate for a share price. So actually, I'll do it up here. Okay, so now we just have our price is going to be equal to, and we've got the $2 per share divided by, and then in the denominator we're going to have the 0.12. That's the cost of equity, and then we're going to subtract out that growth rate, which is 0.03. This is all in the denominator. Ultimately, we're going to have 2 divided by 0.09, which is going to give us a share price, now this is rounded, of $22.22 a share. So this is the share price of this firm. Okay, now we might say, okay, well, what are some issues with it? If it's this easy to value a firm, then why are people paying analysts a great deal of money to go ahead and value a firm if all you have to do is make some estimates and calculate this simple equation? Well, there are a few caveats here that are very important that we don't want to forget about. Now, first of all, when you're calculating this growth rate of dividends, you have to see you're assuming this is a constant growth rate, right? You're assuming every year forever that the firm's dividends will grow at 3%. Now that's a pretty big assumption, right? I mean, in reality, at some point the dividends might not grow. They might not grow at all. The firm might just say, "Well, we're not going to increase our dividends anymore," and the shares outstanding doesn't change. There's a lot of things that could happen, and we don't have to get into all of them. But the idea is that this is very unlikely to actually take place. And if, of course, it's not even possible that the firm. It's very likely the firm's not going to exist, much less forever, but maybe even 100 years from now, this firm might not even be existing. We're assuming this constant perpetual growth rate, which might not is very likely not to be very realistic. So it's kind of a rough estimate. And kind of another problem is, what if the firm is not paying dividends? So what if we have a firm like Twitter, or some kind of firm that maybe it's a in IPO. Maybe we're trying to value a firm that is just about to be offered to have its shares offered to the public for the first time. The firm has never paid dividends. It's kind of a growth firm. We expect the firm to be taking money and investing in new projects, not paying out dividends. So then this becomes even more problematic of trying to estimate the dividends. So this is something a lot easier for a mature firm that's paying dividends and isn't really in that growth stage anymore. Of course, you could use some kind of proxy for dividends. You could say, like, okay, well, if it's a growth firm, instead, we'll use earnings per share as a proxy. But then, okay, well, but earnings per share isn't the same as dividends, so now we're getting even further from what we're trying to do. And so ultimately, it's just important to bear in mind that, as easy as this calculation is and how it spits out this nice, easy to understand share price, and it just takes a few minutes to do this, ultimately it's built on a lot of assumptions. And so you should, just bear those assumptions in mind when you're thinking that you have a valuation based on the dividend discount model.
Okay, that was a, a good video explaining how simple this dividend or constant growth model is, but also how it's maybe difficult to apply it to a startup company or to companies that are not very mature and be able to value their company. But again, it's a start of understanding the process of valuing stock or valuing present value of assets when looking at the potential growth and earnings of that asset in the future and relate that to its current or present value today. Key concept in corporate finance. So as we conclude this week number 3, we look ahead to week number 4 in our cost of capital. Well, we also look ahead to, I also look ahead to reviewing your first case study and your interpretation of a specific company's risk and how you go about presenting that. It gives me a good idea of our looking forward to our future strategic discussions in our class. So again, I'll look forward to seeing you next week in week number 4. If you have any questions or concerns about your casework this weekend, I am available all weekend for any questions or discussions. Thanks, everybody. Have a great week, and we'll see you in week 4. Adios.